Most people believe the interest rate announced by the Federal Reserve is something only economists, bankers, or investors need to care about. But the reality is far stranger. A single decision made in a meeting room in Washington can quietly change how much your next car costs, whether you can afford a home, how much your savings grow, and even whether companies decide to hire or fire people. Most people never notice it happening because the system doesn't move all at once. It moves through invisible channels. By the time it reaches your wallet, it feels like life simply became more expensive. Here's the hidden mechanism. The Federal Reserve doesn't directly control the interest rate on your credit card or mortgage. It controls a much smaller number called the federal funds rate. This is the rate banks charge each other for overnight lending. It sounds insignificant, but in finance, small gears often turn much larger machines. Banks use this benchmark to price loans. Investors use it to value companies. Businesses use it to decide whether expansion is worth the risk. 1 percentage point doesn't stay in the banking system. It spreads through the entire economy like a ripple moving across a lake. This is where psychology enters the story. Humans naturally focus on visible prices: the monthly payment, the sticker price, the rent. We rarely think about the invisible force that determines all of them. Behavioral economists call this narrow framing. We judge financial decisions using what we immediately see while ignoring the system that created those numbers. That blind spot is exactly why changes in interest rates feel mysterious, even though they shape nearly every major financial decision we make. Think back to the years after the COVID-19 pandemic. Inflation surged across many countries, reaching levels not seen in decades. To slow it down, the Federal Reserve rapidly increased interest rates from near zero to their highest levels in years. The goal wasn't simply to make borrowing expensive, it was to cool demand. If people borrow less, they spend less. If businesses invest less aggressively, prices stop rising as quickly. It sounds logical, but the psychological consequences were much larger than most people realized. Take the housing market. During the period of historically low interest rates, monthly mortgage payments looked manageable. Buyers weren't only purchasing houses, they were purchasing cheap money. When rates climbed, the price of many homes barely changed at first. Yet monthly payments exploded. A house costing exactly the same suddenly demanded hundreds or even thousands of extra dollars every month, simply because borrowing became more expensive. Many buyers blamed the housing market. The hidden cause was the price of money itself. Now imagine a $500,000 mortgage. At a lower interest rate, the lifetime interest paid is dramatically smaller than it becomes after several rate increases. The difference over the life of the loan can easily exceed tens or even hundreds of thousands of dollars, depending on the loan terms. But here's the trap. Most people never calculate lifetime borrowing costs. They focus almost entirely on whether they can manage the monthly payment. That mental shortcut allows enormous costs to hide in plain sight. The same mechanism quietly follows you into places that don't even look like loans. Credit cards become more expensive to carry. Car financing costs rise. Student loans may become costlier. Businesses facing higher borrowing costs often delay expansion or reduce hiring. Investors become more cautious because safer assets suddenly offer higher returns. The result is a chain reaction. Less borrowing, less spending, slower growth, sometimes fewer jobs. One interest rate begins acting like a network connecting millions of unrelated decisions. This is where evolution helps explain our behavior. Human brains evolved to solve immediate survival problems. Find food, avoid danger, stay accepted by the group. We weren't designed to understand abstract financial systems operating years into the future. That's why immediate rewards almost always overpower long-term calculations. Psychologists call this present bias. The pleasure of buying today feels real. The extra interest paid over the next decade feels invisible. The system doesn't exploit intelligence, it exploits human wiring. There's another layer most people miss. Higher interest rates don't only punish borrowers, they also reward patience. Money sitting in high-yield savings accounts, certificates of deposit, or certain government securities can suddenly earn far more than before. Yet many people continue leaving cash in accounts paying almost nothing. Why? Because of inertia. Behavioral science shows that humans rarely change financial habits unless forced to. We keep using familiar accounts even when the environment changes around us. The system moves. We don't. The real-world example reveals something even deeper. When the Federal Reserve raised rates aggressively to fight inflation, headlines focused on economists debating policy. Meanwhile, millions of ordinary households experienced the consequences without connecting them to the original decision. A delayed home purchase, a more expensive car loan, higher credit card interest, smaller business investments. None of these events seemed related, yet they were all connected by the same invisible lever. That's the illusion. We experience the effects individually, while the cause remains hidden collectively. Understanding this changes the way you look at money. Instead of asking, "Can I afford this payment?" you begin asking, "What is the cost of borrowing in today's system?" Instead of reacting to prices, you start paying attention to the environment, creating those prices. You stop treating interest rates as background news and recognize them as one of the strongest invisible forces shaping modern financial life. The biggest financial trap was never the extra $5,000 you might lose on a loan, a refinance, or years of higher monthly payments. The trap was believing those costs appeared by chance. They didn't. They were the downstream effect of a system most people never notice. Once you understand that money has a price of its own, you stop seeing the economy as a collection of random events. You begin seeing the invisible network that quietly determines what your wallet can and cannot do.